Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So guys, today we're going to go over the overall portfolio value as well as the buying power, the portfolio by the metrics, as well as the individual holdings and how they are performing. And we're going to take a look at our watch list and what I plan on doing with that buying power. So jumping right in for today, we are up $537.50, a 1% return today. Then for that 1 week mark, we are up $1,812.06, a 3.4% return. That 1 month mark, we're up $1,280.48 with a 2.4% return. Then that 3 month mark, we're up $3,640 with a 7% return. Year to date, we are up $4,955.46, a near 10% return year to date. Then that 1 year mark, we are up $6,362.66, a 13% return in the past year. And then all time, we are up $19,455.97, a 55% return. And guys, I just looked at it. As of right now, all time, our highest number that we've ever had in the portfolio was like 54,789. So we are actually at our highest we've ever been. So I'm excited about that. Um, so the metrics show that, there's been some ups and some downs, but long term we've been doing phenomenal. So I'm glad about that. The buying power did go up simply because we got that Altria dividend of $313, and now we can just let that sit or we can reinvest it. As of right now, I'm going to wait until Realty Income pays me that $44, and then I'll have about 570 some, or 580 dollars and some change, and I'll see where stocks are at, see what Visa, Apple, and say Google or whatever are trading at, the stocks I want to purchase and add more to. Coca-Cola is on that list as well. Some of my smaller positions, see where they're at, and try to make the most, the best decision. Or I might just let it sit in cash and let the cash grow until I have a really good opportunity on one of those stocks. So Realty Income sitting at 5506. We've got 170 shares, $9,300 worth of market value. Average cost is $65.03. 17% of the portfolio is in Realty Income. Today we're up $250 with a near 3% return. Total we're down $1,700 with only a 15% loss. We've been at 17 to 19% for the past 2 weeks. So it is bumping up a little bit, but it's still a good buy for me at these levels. We do have a dividend coming in. Tomorrow is the 11th, so next Tuesday, I believe, next Monday or Tuesday, we do have a dividend coming in of $44.71, and that will just add to our free cash. So at these levels, guys, I would buy Realty Income. The issue is it's such a big position in the portfolio, and I want to allocate towards higher dividend growth companies, something like a Visa. Google, I think, has a pretty good possibility, a better chance of a higher dividend growth rate than Realty Income. Even Coca-Cola, I think, could do a little bit better. So, and Apple as well. So there are just a few more higher growth opportunities that I believe in the future will be higher growth. The main one for me right now, though, is Visa and Apple. Those are the two that I'd want to put cash into. But nothing against Realty Income. I think it's a great buying opportunity. The other reason that I don't want to purchase it at right now at this moment is because I feel like interest rates are one of those things that can last a lot longer. So if I get a dip on Visa versus a dip on this, I feel like the dip on this is going to last longer than the dip on Visa or an Apple dip. Next, we got Altria at 4704. 320 shares, $15K worth of market value. Now we're back to $15,000 in this position. It's been hovering around that, but we haven't really hit that in a while. 47.27 is our average cost, so we're getting real close to break even here. 27% of the portfolio is in Altria. Today we're up $41.60. Total we're only down about $70 with a 0.5% loss. So guys, this is about break even as well. So both this and Realty Income are, coming up a little bit. They're not break even yet, but we are not losing as much money, which is another reason why the portfolio is up so much. Then we got Coca-Cola sitting at 63.14 with 15 shares, about $950 worth of market value. Average cost is right around $61 per share. 1.75% of the portfolio is in Coca-Cola. Today we're up $4.65. Total, we are up $40 with a 4.3% return. Guys, this is going to be one of those core positions. Sorry, my dog's snuggling with me. So if you hear, my bad, she does the little rah, 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 it's collie. So just in case you heard her. But we're up $40. So guys, this is one of those that I'd still buy at this price. I'd buy it at about 65 would be my cutoff. So we're still in the buying range for Coca-Cola. I do want it to be one of those, the bigger positions. I just want to focus on Visa right now because I think it's a better deal. Then Apple's at $2.28, down a little bit today. Not down enough for us, but we have one share at $228.13. Average cost is $132.66. 0.5% of the portfolio or 0.5% of the portfolio is in Apple. A little lower than that, but we'll just round up. Today we are down $5. Total, we're up $95 with a still near 72% return. Guys, if this would just take a realty income dive, that'd be perfect. I want to buy it at like 135 to 140, so I have a long way to go before I purchase some Apple shares. Honestly, I've been thinking about just saying screw it, buying it even though it's a 52-week high and just building up this position because I can always put more money in at a dip. But the issue is I don't have that type of cash right now. But in the future, I'm going to be doing better at saving in my investing. Once my credit cards are paid off, which I'm working really vigorously to do. Once those are paid off, I plan on putting I want to have like about $5,000 saved for my savings account just for my mental, and then I want to have like $5,000 to $10,000 in my investing account to just transfer it over whenever I feel like it. So Apple's one of those that I do want it to be the biggest position, this or Visa, but at this price, it's going to take a while before I'm comfortable purchasing it. Then we got AbbVie at $169.38. We've got 95 shares, $16K worth of market value. $95 is our average cost. Right around 30% of the portfolio is in AbbVie. Today we're up $117. Total, we're up $7,047.74 with a near 78% return. Guys, I bought this during an acquisition, merger and acquisition deal. I did a really good job analyzing it, and I'm happy that it's provided such great returns. I make $150 a quarter on this. The dividend growth has been spectacular. When I originally bought it, I believe the dividend was $1.07, and now it's $1.55. So not only has the stock appreciated really well, but the dividend has grown considerably, which is awesome. So this is one of those that I'm okay to just let it sit, let it pay me, and let the tree grow. So one of the big issues a lot of investors have, and I could do this too, is they sell their winners and they put more money into their losers, and I don't want to do that. I want to be able to let this keep growing. I mean, if the dividend gets cut or the earnings drop a lot, like I knew they were going to drop a little bit with Humira and the losing of the patent, but if there's any huge shift in the business, I might consider selling it. And I have Starbucks or Costco on that watch list constantly. I'm always looking at an option. If this does cut the dividend, I think right now, I think Starbucks would probably be a better option just because it's down so much. And I do like the dividend growth, but I do love Costco stock. So if I had to switch out, I'd probably pick Costco. As a business, I like it better, but as an opportunity, I like Starbucks. But that's just one of those things that, as a dividend investor, as an investor in general, you always have to look at alternatives because anything can happen, right? Apple could lose market share. I hope it doesn't. But if it did, I'd buy it. But with pharmaceuticals especially, it kind of ebbs and flows. When they have a new drug and they have a patent for 7 years or however long it is, they can exclusively make money on that. Well, AbbVie just lost that with Humira. I think last year, middle of last year, something like that. So it recently lost its biggest drug. Well, just because it lost patent approval doesn't mean that it's going to lose all of those sales, but it's definitely going to lose some of those sales. It's not going to have the entire market for that med anymore. So they have Skyrizi and a couple other drugs that they have brought out that have done really well, that have helped kind of stop that impact of losing Humira, but that was the best-selling drug in the world. So they, that's going to be really hard to supplement that cash flow with another drug. They kind of have to hope that whatever they put out to replace it is going to do relative to what the drug made that they're losing out of that patent loss. So I think AbbVie's done a really good job. They've done a really good job investing back into the business. They've done really good about dividend growth and not overdoing it. They've done really good with capital allocation. So overall, I do really like AbbVie. This is one of those that I would consider selling if they cut the dividend, and I'd sell it really fast. So like if AbbVie dropped the dividend by like 50% and the stock price was still, like 100 to 120, I'd sell it. Simply because it wouldn't be my winner anymore, right? Now, if it was like a short term thing and people were overreacting and I had a chance to like buy it at a lower price, I totally would. But something like them losing a huge market share, or a drug flopping and them losing a bunch of money off of it, just if it's, or like a huge CEO change and the company completely shifted the way it did capital allocation, something like that, I would definitely sell the business. But overall, my thesis right now is, my original analysis panned out, and I'm just going to let it run. So this is definitely one of those that I'm happy with, and I do want it to be a bigger position, but I would rather have Apple or Visa be the biggest position in the portfolio. Next up, we got Visa at $261, down $1.46 today. We've got one share, $261.54 for market value. It's going to fluctuate because it mirrors the market. But today we're sitting at an average cost of about $169. Sorry, $269. 0.5% of the portfolio is in Visa. Today we're down $1.46. Total we're down around $7 with a 2.5% loss on Visa. So this is definitely where I'd be putting that $500 if I decide to allocate that capital. Guys, Visa is a monster business. I was dumb to not own it from the jump, but I've learned a lot in my 4 or 5 years of dividend investing. This is one of the highest quality compounders in the entire world. Their capital allocation is amazing. They don't have to reinvest a lot into the business, so they can do sponsorships, have people they can kind of guide people to their payment processing, and advertise and kind of market towards other banks, smaller businesses, stuff like that. They have the capital to kind of lead people into their business, and most of the time they stay. Their overall capital allocation is amazing. They compound at a crazy rate. Their margins are super thin. So this is just one of those golden goose businesses that I should have owned for a really long time. There's so many check marks. Honestly, there's not much that I dislike about Visa except the valuation. Not that I think that it's overvalued, just that it's such a high quality business that the market realizes it, and it's hard to get it at a discount. So this is one of those that it's like Apple, and MasterCard's I think just as good. I just prefer Visa because the month that it pays, and I do use Visa every day, so that's why I prefer it. But there's nothing wrong with MasterCard, and I do think it's a great investment as well. But yeah, Visa's definitely going to be where I put that money if I decide to allocate that capital this month. Honestly, though, I was thinking that I might just let it sit, but if I do allocate, it would definitely go to Visa. Then Google's at 187, dropped big, well, kind of big today, $5, 2%. 3 shares right now. It's down almost 3% for today. Just checking to see, it doesn't seem like it. Nope, it's not going to be below our average cost. But $561.69 is our market value. Average cost is around $165. 1% of the portfolio's in Google. I don't know why it says AbbVie. It does that sometimes. But today we're down $16. Total we're up 65 with a 13% return. So guys, I would buy more at the 170 mark. It'd still have to drop like $20, almost $20, $27 for me to want to purchase it. So about $20 for it to drop for me to purchase it. Sorry, it keeps switching the price. But yeah, I do like Google. I do want it to be in the top 5, but I want it to go Apple or Visa's interchangeable, and then Apple, Visa, Coke, Google, and Berkshire. So that'll be my top 5. So at these prices, I'm not touching Google, but I do want to own it, and I do want to add more to it because I use it every day. I post a YouTube video Monday through Friday. I watch YouTube all the time. So this is just one of those no-brainer investments. Then we got T. Rowe Price sitting at 117, so it's going up, which is awesome. We have 100 shares of this Dividend Aristocrat, 11.7 for the market value. Average cost is around 110 per share, or average cost is 110 per share, so we're doing pretty good on that average cost. 21% of the portfolio is in T. Rowe Price. Today we're up 152 bucks. Total we are up, excuse me. We're up almost about 790 bucks with a 7% return. A lot of sevens today. But guys, T. Rowe Price is one of those that I'm glad I own. I made the mistake of selling out. I put the money into VF Corp, then it cut the dividend twice, then I put it into Tyson Foods, and it was dumb. I should have just kept it in T. Rowe. So I'm just gonna hold it, let it compound. I think this is gonna be similar to an AbbVie in the future. Because if you look at this, there's been a lot of, there's been COVID, it went way up, then interest rates changed, and there's been elections and different stuff. So there's been a lot of things that have affected this stock negatively, and I kind of consider T. Rowe Price a little bit like oil. There is a bit of a boom and a bust cycle for investing, and even though the overall market is up, that doesn't mean that the the brokerages are doing well, because it does affect them. It affects the amount of people in their funds. It affects the returns on their funds, which is the more important thing. And it affects the perception of their funds in the eyes of investors. So I'm sure a lot of people, I know I saw I've brought it up before, but I did see that the PepsiCo CEO was saying, we have a great business. We have like Doritos, Cheetos, we have Pepsi, we have Mountain Dew. He's like, we have all these brands that do really well year over year. We're good at capital allocation. We've been investing back into the business. And I think we've been doing really good with investing at PepsiCo. The difference is that he was just blunt and honest about it. He's like, we only offer a 3% yield. Treasuries are 5%. So why would you put your money in a 3% yield when you could get a guaranteed 5? He's like, that's really all this is. He's like, it's not, people aren't down on Pepsi. People don't think Pepsi's a bad business. People just see a higher yield and they're going to move to it. He's like, so overall, he's like, I'm not going to be surprised if Coca-Cola or, some of these smaller yielders like Visa, Costco, whatever. He's like, whatever the stock is, if it doesn't pay 5%, you have a high opportunity cost. You have a high switching cost if you can make 3%. And the stock price fluctuates versus a guaranteed 5% on a U.S. Treasury. There's, to some people, if they want a guaranteed 5% return, they're going to pick the Treasury. So I think that's some of what's going on with this as well. Interest rates went up, and they do have a decent yield here at 4%, but it's not 5%. So you're losing out. If you want a steady Eddie return of a 5%, you'd pull out of this and put it into a U.S. Treasury. So I think that's part of what's going on. I think it's less affected than realty income, but it did have some direct correlation to why the stock is down. And eventually I do think that it could get up to that 220, and this could be a $22,000 position. And the dividend at that point, I think, would grow as well. The only issue, if it does go up that high, I would have to consider reallocating capital, simply because, just like with AbbVie, it's kind of weird to say it, but I'm not getting paid the dividend that I would if I owned those shares. So what I'm saying with that is I own 100 shares at 109. But as the stock goes up, if you divide that by my average cost, I'd have a higher dividend. So that's always how I look at it, is how much more money would I make if I was at my average cost. And that's an opportunity cost that I always look at. So like with AbbVie right now, I make $150, but I would pretty much double my cost, so I could make almost $300 at my average cost. Now, do I want to sell that $7,000? No, I don't think it's worth it. And considering that I've looked at Costco and Starbucks, I've looked at other stocks, and they don't pay me $150 for the same capital that's in AbbVie. So not only would I lose that upside on it, I would erase those gains by selling it in AbbVie. I would also lose out on that dividend income that's less than what I would get from other companies. So sometimes that works. Other times, I just would rather leave it there. So I've done that a lot with companies. Altria included, and nothing's come close to because it's a 9% yield. So, and just because the yield's higher does not mean it's a better business. So that's another thing too. Is if Visa ever gets low enough that capital, which it would take a huge drop, but if Visa ever gets low enough to the capital allocation scenario being that the money into Euro price put into Visa would equal out to $124, which that would have to go down to like $50 a share or something crazy. I would do it because I like Visa more, but I like where my capital is allocated and I like the overall return I have more right now into Euro price. So it's just opportunity cost, and I do that a lot. I always try to like show a different scenario to myself. I always try to keep myself, thinking of new ideas in different scenarios, because honestly, even though it's into Euro price right now, I think overall Visa's the better stock. I think Visa's going to grow more. But my main goal is to grow my passive income. So even if my overall net worth goes up, I lose that cash flow that I actually want, because that's the goal of the portfolio. I have my 401k to build my overall net worth. Like that's what that's for. This is just side money that I'm using to, live off of in the future. So then, guys, of course, we've got Berkshire Hathaway sitting at $4.15. It's going up. I want it around $400. I said in yesterday's video, I'm literally just going to buy this for Christmas. So I owe myself quite a few shares. So 2018, 2019, 2020, 2021, 2022, 2023, 2024. So by the end of next year, I should owe myself like 8 shares, which is $3,200. 3,300 bucks. So I'm behind on the Berkshire train. That's okay. I will buy like 10 shares eventually, but I do think that's a good way to celebrate. My investing journey is just do a share a year, and I might do more than that, given the stock dropping or anything like that. And if there's a bad sentiment in the market or something shifts or something like that, I'd definitely buy more. But as of right now, my IOU for Berkshire is 8 shares, because I've had 8 years of investing. So guys, the portfolio is around a 52-week high. I'm super excited to see where it goes from here. I'm going to let that capital sit for now until Realty Income pays me. And then next month we'll have AbbVie, Realty, and Apple paying me. So we grow every month, guys. That's the goal of the portfolio, is my passive income grows every single month. And the beautiful thing is now I'm not even having to put in extra capital because I'm paying off my credit cards, and it's still growing. So I just love it. So thank you guys so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy, if you guys are enjoying the Monday through Friday updates. Thank you for watching, guys, and I'll see you tomorrow with another Robinhood portfolio update. Take care.